You don't just want to go loads of high yield bonds, for example. They may be slightly more defensive, but ultimately they are positively correlated. The duration will perhaps protect in a scenario where we get a recession, that perhaps energy prices do fall back, but actually there's enough damage and a recession plays out. Actually, duration will be defensive there, and I think we're keen to have different expressions of defensiveness. So things like gold, things like infrastructure, they all perform at different times, and we've had multiple different types of crises, and different assets tend to do well. It's very difficult to anticipate which ones those are going to be ahead of time. When you mentioned gold, we don't just want a simplistic defensive assets are government bonds, aggressive assets are equity, and leave it there. We want to have a little bit more nuance to that.
That makes sense. And obviously duration being a lever that you could pull leading up to 2022 when interest rates went up, and if you were stuck in a high duration fixed income carve out, you experienced quite dramatic, almost unprecedented capital losses in 2022. I think in some portfolios, those portfolios are still recovering today, which is interesting. But that makes sense.